When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS, and we know that. We've talked at length. John Williams says inflation's 11%, shadowstats.com, not 3. So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think, but even at 3%, and they're trying to push rates down below that. But even say you get a 5% return, right now you're losing in real terms by John Williams' measurement a negative 6% real return. And in that environment where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of...
The $4,000 threshold has been breached by gold. The global markets are emitting warning signals, and silver is currently testing $50. However, Alasdair Macleod and Andy Schectman contend that something significantly more significant is transpiring, despite the fact that mainstream analysts refer to it as a transient correction. They caution that this is not a typical market move. It is a calculated reset. Central banks and significant institutions are extracting physical gold and silver from the global system behind closed doors, while paper traders are being coerced out of their positions. Schectman characterizes it as a wealth transfer that is concealed in clear sight. As Macleod asserts, it signifies the conclusion of fiat currencies, a trust crisis that has been developing for decades. At present, exchange facilities are losing billions of dollars worth of metal. Your financial future will be determined by the events that occur in the future, whether you currently possess gold or silver or intend to do so. We should return to the interview, as this message may be the most significant you will receive this year.
Important to highlight those in the respect that a lot of what Alasdair is talking about it deals with just this: monetary inflation, asset valuation, the inflation-adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS, and we know that. We've talked at length. John Williams says inflation's 11%, shadowstats.com, not 3. So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think, but even at 3%, and they're trying to push rates down below that. But even say you get a 5% return, right now you're losing in real terms by John Williams' measurement a negative 6% real return. And in that environment where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alasdair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. like he's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, yeah, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So yeah, right now I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries, like the banks and the insurance companies, and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up, in essence, our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it, actually, and he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alasdair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60. How about last year? Same thing. When you measure, if you go back to 1971, James Rickards would say gold should be $94,000 right now, measured against gold. When you measure the dollar against a basket of worthless currencies, it's masked. So everything that we are doing is stacked against us in measuring against a basket of worthless currencies, measured against gold, and everything is falling in price. And I think the asset managers must understand that even the best laid plans, those that have worked for 50 years wonderfully in an environment of dollar supremacy, in trust of the institutions of this country and of the bond market that has been weaponized and sanctioned, those things aren't the same anymore when that environment changes. So yeah, to Alasdair's point, you must pivot if you are looking at a macro perspective here. And when you see all of this congregation in the equity market on leverage and on margin and using options at record levels as the institutional sized traders and have been selling all year, and Buffett sitting on $500 billion in cash, what could possibly go wrong?
Andy Schectman commences with a cautionary tale that few are acknowledging. In the last month alone, nearly $25 billion worth of gold, totaling over 5.8 million ounces, has been withdrawn from global exchange vaults. These are not retail sales or small transactions. Central banks, sovereign funds, and private institutions are discreetly extracting metal from the system through substantial physical deliveries. This item is not being sold. Schectman asserts that it is an egress. He elucidates that the recent gold and silver collapse was not a market reaction, but rather a premeditation. In the most unsettling trading hours, when New York was closed and Asia had not yet opened, billions of sell orders were displayed on the screen, which resulted in the activation of automated stop losses and a significant decline in prices. No rational trader would ever dispose of that much metal in a non-existent market. He claims that you would only do so if you intended to frighten the world out of its current state. The same players who were responsible for the price decline stepped in to purchase physical metal at deep discounts as soon as the price collapsed. Accumulation, which appeared to be hysteria, was actually a deliberate wealth transfer that was disguised as weakness. Schectman observes that conch deliveries have increased month after month since late 2023. While refiners report delays and premiums on large bars are increasing, registered inventories continue to decrease. His argument is that if this were a genuine liquidation, you would observe orderly sales rather than flash dumping followed by record deliveries. The objective is evident: shake confidence, restrict prices, and allow institutions to reload before the public realizes that the supply is diminishing. Alasdair Macleod subsequently establishes a connection between these actions and the overarching issue of the gradual demise of the fiat credit system. For more than 50 years, governments have inflated fictitious wealth through derivatives and debt. Presently, that shell is disintegrating. His warning is that our fiat currency is the next to fail when confidence is lost, as every fiat currency in history has done. Investors sell what they can rather than what they desire when liquidity becomes scarce. In the ensuing scramble, the sole assets that are not subject to counterparty risk are gold and silver, which are held outside the banking matrix. He serves as a reminder to the audience that gold is the ultimate settlement under common law. Everything else, including bonds, ETFs, and fiat currency, is merely a promise. Capital returns to tangible value when faith in those promises is undermined. Today's gold-silver ratio of 83:1 is mathematically preposterous. According to Macleod, this disparity, which has historically been around 30:1, indicates that silver is poised for a significant increase as reality begins to take its place. In the interim, the East continues to deplete the vaults of the West. The Shanghai Gold Exchange in China is experiencing unprecedented deliveries. Indian silver imports have increased by over twofold, and central banks, including those of China, Turkey, and Singapore, have already acquired more than 900 tons of gold this year. Schectman asserts that this is not mere speculation. This is in anticipation of the implementation of a new monetary system. They conclude with identically straightforward statements. Obtain a physical examination immediately. Schectman refers to gold and silver as insurance against the loss of faith. Macleod concludes, they are not investments, they are lifeboats.
Certainly, during this fiat currency life, which is now, 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management. Bank of America another trillion. Trillion here, trillion there, and all the rest of it. And they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. Really. And there's another problem, and that is that how do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF. But an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly. And it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. You've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world, their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are you going to come from? It's just not there. So I think we're in a situation which we've already beginning to see a squeeze in the market. And this is something Andy is probably a lot closer to than me. But when I saw all that stuff going out of the Bank of England back in April, the trucks backing up and being told, come back at the end of the month, I started thinking, that's basically leased gold, which before then was just remaining in the vault. Okay, it was a book transfer. So the Bank of Finland would own, say, they would lease, say, 50 tons, and it would be leased to XYZ. It was a book transfer because it would remain in the vaults. Now it's disappearing. Now, if I was a central bank, and I don't think I'm stretching my imagination too far, I would think, hold on, I don't think I want to get involved in this leasing game anymore. I think I'm going to stop leasing because it's now getting more important that we actually have possession of our gold, or at least have it stored without any encumbrances, such as out on loan to someone else, leased to someone else or whatever. So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. Liquidity that's keeping the paper market going, because this leased gold, it gets hypothecated, rehypothecated, rehypothecated. It just goes round and round and round, and it's like spinning plates. You used to have those chaps on the stage with spinning plates on the end of, and you'd go around and get dozens of these things spinning, and see them starting to fall. To get round and sort of get them going. That basically is the gold leasing game. And a lot of this gold has actually gone. It's disappeared. I mean, the leasing game has been going for so long. Analysts back in the last century were looking at it and saying, where's it gone? And they were assuming that after a lot of diligent research, I should add, that up to a third to a half of all central bank gold by 2002 was out on lease. And the way Frank Venerosa put it was probably adorning the necks of women. I actually think China bought it, but who cares who bought it? It's not there. I mean, that's the key thing. So we actually do have...
Therefore, pose this inquiry to yourself. Why are ordinary investors still waiting when central banks, sovereign funds, and billion-dollar institutions are discreetly draining the vaults? Do you anticipate that digital currencies will dominate the future of money? Or do you believe that gold and silver will serve as the foundation for the next monetary system? Please share your thoughts in the comments section below. Every single one of them was examined. If you received value from this analysis, please consider liking, subscribing, and sharing this video with others who are interested. Because the current situation is not a mere speculation, it is a fact. The dollar-based system is approaching its conclusion. The sole thing that matters is what is genuine when the curtain falls. In a world that is awash in promises, it is important to remain vigilant and informed. Remember, gold and silver are the embodiment of truth.